Cost Accounting third year, part Professor نبيه, lecture 2. Last lecture we have finished discussing the main differences between absorption and variable costing. Today we are going to solve a numerical example. To refresh your memory, last lecture we summarized the differences between variable and absorption costing in the treatment of fixed manufacturing cost. Under variable costing, fixed manufacturing cost treated as expenses of the period or period cost. Under absorption costing, fixed manufacturing costs are inventoriable costs. Assuming this example, in this example we assume that no difference between budgeted data and actual data. Starts with beginning inventory, no beginning inventory for simplicity. Selling price $100, sold units 60, produced unit actual production 100 units, which is equal the budgeted production. Unit variable costs, manufacturing 30, selling and administrative costs 5, fixed costs as lump sum, manufacturing 4,000, selling 1,200. You should first calculate the fixed manufacturing cost per unit, the fixed manufacturing cost per unit, which equal fixed manufacturing cost, budgeted fixed manufacturing cost 4,000 divided the total production units 100, 4,000 divided 100, fixed manufacturing cost per unit equal 40. The second thing you should calculate from this data is ending inventory, number units in ending inventory, which equal produced units 100 minus 60 units sold. So the unsold or ending inventory units equal 40 units. The income statement under absorption or full costing comparative to the income statement under variable costing, we start with calculation the sales or revenue. The selling price per unit 100 multiplied by 60 units in both income statements. The amount is the same, 6,000 less cost of goods sold. Here calculate cost of goods sold as residual value. Start with beginning inventory plus cost of goods manufactured minus ending inventory to reach to the cost of goods sold. Beginning inventory will be 0. Cost of goods produced or manufactured equal, under absorption costing, $70 multiplied 100. Under variable costing, 30 multiplied 100. 70 here comes from variable costing, variable manufacturing cost, which equal 30 plus the $40 fixed manufacturing cost per unit we have calculated. 30 plus 40 equals 70. Under variable costing we use the variable manufacturing cost only, which equal 30. Cost of goods available for sale equal beginning inventory plus cost of goods produced equal in absorption costing 7,000, in variable costing 3,000, minus ending inventory. Ending inventory, we can calculate ending inventory in both absorption and variable costing as we calculated the cost of goods sold. The difference will be in the number of units. Ending inventory 40 units. So ending inventory in variable costing 40 units multiply $30 variable manufacturing cost only 30 multiply 40 equal 1200. Under absorption costing the total manufacturing cost per unit, which whether is variable or fixed, 30 plus 40 equals 70. 70 multiply 40 units equal 2800. Subtract the ending inventory from cost of goods available for sale equal cost of goods sold. Under absorption costing, cost of goods sold minus sales equal gross margin or gross profit. Under variable costing, we subtract cost of goods sold and also less variable selling and administrative costs to reach to the total variable cost. The total variable cost consists of two parts: the cost of goods sold, which include variable manufacturing cost and variable selling and administrative costs, to reach to the total variable cost minus sales equal contribution margin. This is the second difference in absorption costing. Cost of goods sold minus sales equal gross margin or gross profit. Variable costing approach, sales minus total variable cost equal contribution margin. Total variable cost consists of two parts: variable cost of goods sold and variable selling and administrative costs should be added to get to the total amount of variable cost. Under absorption costing, we subtract from the sales all manufacturing cost, still non-manufacturing cost. Selling and administrative costs, variable and fixed, should be subtracted from the gross margin to reach to the operating income. On variable costing, we subtract all variable cost, still all fixed cost. So fixed manufacturing cost and fixed selling and administrative, 4,000 plus 1,200, subtracted from the contribution margin to equal to the operating income. We can see the difference in operating income is equal to the difference in ending inventory, because part of fixed manufacturing overhead will included in the balance sheet, not in the income statement under absorption costing. Now we will solve some MCQ. Under variable costing, fixed manufacturing overhead costs are. Under absorption costing, fixed manufacturing costs overhead costs are. Under variable costing, fixed manufacturing overhead costs are product or period. Under variable costing, fixed manufacturing overhead costs are period cost. Under absorption costing, fixed manufacturing overhead costs are product cost. So the answer will be The only difference between the net income between a variable costing and absorption costing is the treatment of fixed manufacturing overhead costs. The answer is D. Is used for external reporting, as we have said in the last lecture. Absorption costing is used for external reporting. Variable costing used for internal reporting and performance evaluation. Fixed manufacturing overhead costs are excluded from product costs under absorption costing. False. When the variable costing method is used, fixed factory overhead appears on the income statement as, under variable costing, the fixed factory overhead appears on the income statement as component of cost of goods sold, and production volume variance, fixed expenses. Another simple numerical example. Under variable costing, the product cost per unit is. Under variable costing, the product cost per unit is variable manufacturing cost. Direct material used, direct labor, variable overhead. The production, selling price, sales, no ending inventory in direct material or work in process, only ending inventory in finished goods. So the total, I want to calculate the total production. The total production equal sold units, which included in the ending inventory 400, plus the sold units. We can calculate the sold units by divide sales over selling price. 480,000 divided 300 equal 1,600, plus 400 equal 2,000. So the total production equal 2,000. We need to calculate the manufacturing variable cost per unit. So we calculate first the total variable manufacturing cost, direct material used, direct labor, variable overhead, plus 480,000 divided the 2,000 units total production. So the variable manufacturing cost per unit 240. Under variable costing, the product cost per unit is 240. The answer is D. Under variable costing, the cost of finished goods ending inventory is, the 240 should be multiplied by the number of ending inventory. Ending inventory finished goods 400. So 240 the variable cost, the variable manufacturing cost per unit multiplied by 400 units in ending inventory equal 96,000. The answer is D. Under variable costing, the variable manufacturing cost of goods sold, the same thing, 240 the variable manufacturing cost per unit multiplied by, instead of number of units in ending inventory, we multiply 240 by the sold units, which equal 1600. The answer 384,000. The answer is also D. Under variable costing, the contribution margin is, do it yourself, calculate the total variable cost. We calculated the cost of goods sold equal 384,000 To reach this contribution margin, we should subtract the all variable cost. So variable selling and administrative expenses should be added to the cost of goods sold, the total variable cost 404,000 subtracted from total revenue or sales 480,000. Contribution margin should equal 76,000. The answer is C.